Everybody, Dave here, Hidden Freedom Investing, and I have a fantastic doozy for you today. Today's video is all about how to take your dividend portfolio, increase the income by 55%. Yes, you heard me correctly, 55 freaking percent. So let's go ahead and dig into the video. Yes, you heard me correctly. We're going to take this dividend portfolio and we're going to increase the income, the annual income, by 55 freaking percent. And I don't even know why I keep saying freaking. Probably just because I'm excited, and I hope you are as well. So we are going to use a simulated portfolio today. If you want to take a look at my actual portfolio, I'll link it up here. Now that portfolio is not quite big enough to use an example, but hopefully going forward as I build this portfolio out, this will become a strategy. This particular video, what it's all about is using leaps to increase your income safely with zero downside risk, in my opinion. Now I don't know if people can debate that or not, but I'll kind of tell you what happens even on the downside. So what are leaps? Leaps are long-term equity anticipation securities. Now theoretically, when people refer to leaps, they use that is kind of just meaning that they have an option that expires the next calendar year. So if we're in January of 2020 and they have an option that expires in February or January of 2021, typically that far out, they're usually in January of 2021, January of 2022. So they're exactly the same thing as a put and a call option. There's really no difference between them other than calling them leaps and that they expire the next calendar year. So in this example, we're going to use leaps that expire in January of 2021 because it's the closest one. We're basically in February of 2020, so we're going to use leaps in this example that expire in January of 2021. So let's go ahead and dig into the simulated portfolio. So here is our simulated portfolio. So we have 15 positions in this portfolio because we take basically a line one and out of there and minus that 16, you get 15. So we have 15 positions here. That's spread across 11 sectors. I got the weighting very close, not perfect, but very close to the S&P sector weighting. So I got a little bit of diversity here because I got financial spread across two, JP Morgan and Wells Fargo, because that's probably one of the weakest sectors in my opinion. There's one energy stock there. There's a couple of different consumer staples. I'm a little overweight in consumer staples in this example, but I think consumer staples is going to perform very well in a recession, and it's pretty, we got some really good companies here. We got Microsoft in there, we got some AT&T for the communication sector, we got realty income, or reality income, whatever you want to call it. And reality is that that is a super popular and super stable stock that's a dividend aristocrat. We want to take a look at dividend aristocrats here. We scroll over, and almost every single one of these stocks is either a dividend aristocrat or a king. And as I said earlier, we got JP Morgan and Wells Fargo in there, and those are not aristocrats or kings. They had issues in the financial crisis, and who knows what will happen during the next recession. I don't think the same thing will happen in this particular recession, so I think that's pretty stable, and that's the reason why I spread it across two different stocks, just to kind of have a little bit of redundancy there. The only other one here that is not aristocrat or king is Microsoft, and they got so much money, they got free cash, and they're 18 years right now, so they're quite a ways away from being an aristocrat, but I do believe they will be one. So we have that in the portfolio for the tech exposure. So the only thing that really matters in this simulated portfolio is we got $226,000 in this portfolio. Okay, now if you notice that the number of shares are equal, because using options contracts, every contract is equal to 100 shares. So that's the reason why I have exactly 100 shares in there. Or 100 share increments, I should say. So, communication sector, we got 500 shares because it's a very low cost stock. So we got 500 shares of that, and I'll kind of show you that in a minute. This generates, a simulated portfolio generates a annual income, dividend income of $6,900. And in addition to that, we also have a dividend yield across this portfolio of 3.22%, and our actual average weighted dividend yield is 3.10%. So we come in slightly below what the actual yield is on the stocks, and that is because Microsoft and all that is a super low dividend paying stock. So it is what it is. We got 3.10% out of it. We got $6,900 were generated out of it. And just for this example here, the dividend CAGR is 7.5% of growth there. So looking at the sector weight for this particular portfolio, if you actually pulled up the S&P 500 sector weighting, these are actually very close to what the actual S&P 500 sector weighting is. Now, as I was saying earlier, the consumer staples actually is a little bit high, and some of the other ones are a little bit lower than what they should be, like information technology. But like I said earlier, consumer staples has some really great companies in it, and they're lower beta. So the information technology sector, I think, is supposed to be about 20 to 22%. We're only at 16% here, and I'm okay with that trade-off. If you wanted to get more exposure, you could add some, IBM in there, or some Cisco or some Intel or something like that with a little bit higher yield. But at the same time, this portfolio has actually got a pretty low beta. I think across the whole portfolio is about a 0.74. So that's actually going to perform pretty good in a recession. It's not going to decline as much as what the market would. So just want to let you know that it did have a diversified portfolio here. It generates $6,900, $226,000 portfolio generating that $6,900. So how are we going to increase this by 55%? Well, we're going to use some leaps. So let's go ahead and take a look at that. Okay, so what I did is I took the portfolio from above and I created kind of a new chart here, or a new spreadsheet, and it's got a bunch of new information in it we haven't seen yet. So let's go ahead and scroll over. Now this whole information right here is exactly the same as above. These are current prices as of today, February 19th. And so this is all based off of February 19th information. And obviously, going forward, come February, March, April, May, June, July, for 2020, all this information is going to be different, and you have to do all the calculations over again. But let's just say that we took that portfolio and we're going to sell the leaps, and kind of look at the numbers as of February 19th. So let's go ahead and scroll over here and show you what I did. So the number of contracts is basically, what I took the contracts, if we had 500 shares, I took 5 contracts. If I had healthcare of J&J, which it has 200 shares in that particular stock, that equals 2 contracts. So every 100 shares equals 1 contract. So that is how I come up with the number of contracts. All right. And then what I actually did at this point is I looked at the options contract for every single one of these stocks one at a time, starting with Nucor here. And what I looked at is I looked at the 52-week high, and I tried to find something that was somewhat close to the 52-week high where I could actually get a decent amount of income from it, but at the same time I didn't really have to worry about it hitting the strike price in a year. And it's not really a big deal if it does, and we'll talk about that later. But because Nucor is at a current price of $47, that is basically, near the 52-week low. So it's very hard to get a strike anything above 62 and still make some money from it. So that's why I went with a 60 strike price. And even with a 60 strike price there, the contract was only worth 72 cents. And you times that by 1 contract, which is equal to 100 shares. So you times that by 100 and you get $72 of income. So yeah, that's just a bad example there, but we'll go through some other ones here. DTE is days to expiration. All right, so we have 332 days to expiration, and these all expire in January 15th or January 15th, 2021, every one of these, okay? Now, the days to expiration includes weekends and holidays and all that stuff in there, so technically, that is not all trading days, all right? So there's 20 trading days per month, and then there's some holidays thrown in there and all that. So guess what? You're basically having theta killing out the premiums in your favor every single day, and including the weekends and holidays, so... let's use another example here. Now, realty income is probably not a good example, but it still works out because that one is near, you know, kind of a near 52-week high here. So the 52-week high is $82. Current price is $79.67, and I sold a strike at $87.50. Okay, so and days of expiration obviously is 332, and we have 100 shares, so that's one contract, and cost per contract was $2. That's crazy. We can go all the way out to $87.50, which is, you know, $5 higher. Okay, so $5.33 higher than what the 52-week high was. So that collects, we can collect with that $200 of annual income. So going forward here, I don't really want to go through every single one of these. You kind of see what I'm doing here. Now we're going to look at some other, you know, high cost ones here. Let's look at Microsoft, an example here. Microsoft, you know, $18,000 invested in Microsoft. We have 100 shares, $187 is the current price. Okay, now that is right just near the 52-week high of 190. All right. Guess what we did? We could go all the way out to the 240 strike price, which is $50 higher than the 52-week high. All right, and guess what? It's still worth $3.50, and we times that by 100 because that's how much each contract controls. And guess what? We generated $350 of income from that. And let's use another one example here. Let's go ahead and take a look at AT&T is another one because we've got 500 shares in there at $38.44, which is somewhat near the 52-week high. And we got 5 contracts, obviously, because it's got 500 shares. We divided by 100. And guess what? I took a strike price of 42, which is higher than the 52-week high of by $2.30. And guess what? Every one of those contracts is worth 80 cents. So we times that by 5 and we come up to $400 of annual income we generated from that. So let's use one other example before we scroll over to the right here, and that is J&J, because J&J is an awesome company. And we got 200 shares of that. That's our top weighted stock in this portfolio with $29,000 invested in it. And right now it's at 148 per share, almost 149 per share. And the 52-week high is $154. So guess what? I went out to the 165 strike price, okay, and I times that by 2 times 100, and I basically times that by $3.08. We come out to $616 of annual income I generated from selling those covered calls. So that gives us a buffer of over $10 of capital appreciation, and that's kind of what these are showing here. So I kind of did some other calculations. Let's go ahead and take a look at that here. So plus minus 52-week versus the strike price. So what that's looking at is it's looking at the strike price here, and it's also looking at the difference between the 52-week high. So if it's negative, it means that we have a strike price that is lower than the actual 52-week high. Now there's only a couple stocks that happened on, and that's on stocks that are near the 52-week low. And, you know, for example here, ExxonMobil has a big sell-off this whole last 6 months or so. So it's very tough to get a strike anything higher than the 80 here and still generate some income. As you can see here, I got a strike of 80, and that is lower than the 52-week high, but I can only generate $44 of income. So that's what these negatives kind of show here. It just shows you that the strike is lower by $9.75 of what the 52-week low is. These red indicators here just kind of show you that we're $9.75 less than what the 52-week high is. All right, now this is the percentage that it's actually lower. So 4.4% is how much lower our strike is, lower than the 52-week high. And this is kind of just a gauge. You don't have to use this, but it kind of just gives you an example that, hey, you know, we got JP Morgan here that we have a strike price of 160. That's 52-week high is 115. So we're basically $44 above that strike price, and you know that's 38%. So in order for that to even be in the money, it's got to go up $44. So I did some other calculations here as a kind of just an example. So what's the per share upside money looking at here? This column, this is actually looking at the current price minus the strike. All right, so that has nothing to do with the 52-week high. It's taking the current share price minus the strike, and that's the capital appreciation basically that we could get out if the stock hits our actual strike and be in the money. Okay, so basically, you know, Pepsi is a good example here. We can go up from the current price that we bought it at, $50, and make $50 per share before we even are in the money. Okay, so why am I even using that? Because so if every single one of these stocks by January 15th, 2021 was all in the money, okay, that means every single one of the stock prices here hit this strike price, okay, for the, you know, for the various stocks in this particular portfolio, then this is how much money we would make in capital appreciation. So that's $37,848, all right? Now we're gonna use that as an example in a minute here because that kind of matters, but so we have a 17% capital appreciation upside on average across the whole portfolio. So we have probability of in the money here, and what that means really is the probability of the stock being after 332 days of being at the strike price. So, you know, as you can see here, we got some that are higher and lower than the others, and you know, there's reasons for that because I wanted to get some decent income out of it, but I wanted to be safe at the same time. So in this case here, Nucor is about 11% chance of hitting that strike by 332 days. Let's use Microsoft as another example here. We got about 11 to 12% chance that that's actually going to be at $240. Now these are just probabilities, and then there's a calculation I get out of Thinkorswim, and that's where I'm grabbing that from. Theoretically, that kind of could mean delta as well. So, and one last thing we really care about here is the actual income that we're generating by these leaps. Now we're selling these basically these calls out, and we're generating the income, and it generates over $3,800.56. Okay, $3,856 of income we're generating. You add that to the dividend portfolio income of $6,900, we get a total combined income of $10,764, and that is a 55% increase of income. And here is the income. So we got $226,900 of dividend portfolio, you know, capital invested. We got the dividend the dividend yield across the whole portfolio is 3.04%, which generates $6,908. And then we got the leap income of $38.56. The leap yield is 1.7%. You combine that together, you get a combined income of $10,764. The combined yield is 4.7%. That's an increase of 55.8% of income, and that is safe income because I'm going to tell you there is no downside risk at all. Let me tell you what the scenarios are that could happen. So let me give you the two scenarios that could happen, or maybe in three scenarios. So one scenario is every single one of these stocks hits the strike price by January 2021, and every one of your positions here, it gets called away. Okay, because that's what's going to happen. But at the same time, you're going to keep that $3,856 of income that you got right when you sold these. Okay, so if you sold them on February 18th, February 19th, you collect that immediately, so you can deploy it into more stocks immediately if you want. Come January 15th, if this is 1 penny in the money, you're going to collect that $37,884 of capital appreciation, and all your stocks are being called away and taken out of your portfolio. All right. Is that a bad thing? Not really. I mean, it could be in a sense that, you know, if you have to deal with the tax, you know, ramifications of this, right? That's the only downside of doing this scenario is you're worried about, you know, your stuff getting called away. You're going to have to deal with the, you know, capital appreciation of being sold at whatever stock price your strike price is, right? So that's the only risk, in my opinion, is you're going to have to deal with the tax consequences. If anything is in the money, then it's going to get called away at that strike price, which means you're going to have some capital appreciation. So what's the flip side? The flip side is let's say we have a recession and the stock market gets cut by 50%, which is most likely won't happen, but let's just say if it does, well, guess what? You're gonna collect that 3,856, that's just gonna stay in the bank, because the day you sell these covered calls is the day you collect that money, and that you can deploy into other stocks immediately. That is yours to keep. Now, most likely what's gonna happen is if we had a recession of 50% or something like that, in worst case scenario, so every one of these strike prices is gonna come down in value. So what you could do is you can just let them expire, all right? Now you're gonna just collect that $3,800 and keep that, and it's not gonna be a big deal. Nothing's gonna be taken out of your portfolio because nothing's gonna be close to the strike price. Or the other thing you could do is you could buy them back for half price, maybe even less than half price, and, you know, bank $1,500 and then start the whole process over again. This is a very tough video to get out without being super long, because there's so much information I want to get out to you. If you could just leap onto that like button, I'd really appreciate it. So I'm trying to keep this as, you know, basically to the point as I can. If I have to do another video on this, I certainly will. But the last thing I want to just kind of mention here is you can mess around with the strike prices if you want to go super conservative and way out of the money, even more than I've already done here. The difference is your capital appreciation is going to go up if it actually hit the strike price, but your actual income will go down, okay? So if you don't want to be as conservative, you want more income, you don't have to be as conservative with your strike prices. You can actually be a little more aggressive and just put it right above the 52-week high, or even slightly below it if you want to. And you can increase your annual income, but your capital appreciation, you know, if it actually hit the strike price, will go down, all right? So you can mess with these numbers. These are not basically set in stone. You can, you know, lower this, you know, Microsoft one, for example, down to 230 or 220, get more income out of it, but less appreciation if it actually hit that, okay? So I kind of wanted to go more conservative, but still wanted to get some decent income out of it. But, you know, theoretically, you could probably increase this up to about $5,000 or $6,000 of income by being a little more aggressive if you wanted to. So these are, they're not arbitrary, but there's a lot of wiggle room in these. I just want to let you know about that, okay? So, you know, if you have any questions about this strategy or anything about the downsides, the risk, let me know. I'm going to be using this strategy because I need the extra income in early retirement, and there's zero risk in my opinion at all. You're still going to collect money on the downside. You're still going to collect the money on the upside. I don't understand why people would be afraid to do this. You're still going to drip if you want to drip. You're still going to compound if you want to compound. So that is all still relevant. There's nothing changing with that at all. So one thing to note here, if you are in a tax deferred account, then you may not have to worry about the capital appreciation at expiration, whether or not any positions were in the money and they got called away and you had to pay all that capital appreciation. You may not have to worry about that with taxes. But if you're in a taxable account, then you may have to, you know, be aware of that and, you know, account for that. So just be aware of that. If you're in a taxable or a tax deferred account. You know, also in addition to that, you know, the more money, the larger your portfolio is, the more shares you can sell calls against, and the more income you can make. So theoretically, in this example here, it's 1.7% that we're generating in leap income. Now, if you had $1 million portfolio, that's a lot more income that you can generate, okay? So just be aware of that. In addition to that, you don't have to use leaps. You could technically do monthlies as well. In fact, with monthlies, you could probably even be more aggressive with the strike prices and generate more income over the 12 months than using leaps. Leaps, in my opinion, are just, you know, set and forget. You don't have to worry about it for a whole year theoretically. Now, if you're kind of a control freak and you want every possible amount of income that you can get out of it, you can do monthlies to be more aggressive on your strike prices and generate a little bit more income than the leaps. So just be aware of that as well. Go ahead and leave me a comment below if you like this video. Like I said earlier, go ahead and cover call that like button. And go ahead and subscribe if you're not subscribed already. I really appreciate it. It helps me out. And we will see you in the next video. Thanks for watching.